Hi, this is David with Enzo Trading System. Today we'd like to talk about our approach to algorithmic trading. I've been asked a few times, especially recently, about what we do. The most common question is actually if we use high frequency trading. So I think it would be nice to clear up if we do use it, why not, and what we actually use. So we don't use high frequency trading. Our sites mentioned high frequency data. We did use high frequency data in the past with some algorithms, but never actually done many trades per second, or what one would categorize as high frequency trading, or not even many trades per minute or per hour. So there's several reasons why we don't do it. I personally think it's overrated, but I think somehow it became something exciting that appears in documentaries, and I guess the frenicity of the idea of high frequency trading really captures the imagination. So there's several problems with it. First of all, it's a lot of data. It's a very large amount of data, so it's difficult to gather. Um, For example, we do gather high frequency data from Binance, but there is a rate limit for it. So we started actually a couple of years ago, and it does take quite a long time just to take data from some markets. And it's much slower to process. So I would say, I don't know, maybe 100 times slower. So when you're developing an algorithm, you really want a quick turnaround, whether you're just editing manually, thinking about it and trying a few things, or even if it is just some automated process like machine learning, you obviously get a lot faster results, and you can use more complex approaches when you don't have as much data, which I think generally is quite redundant. But yeah, so I think I can actually show what some frequency data can look like. If I'll zoom here, it's not very active right now. This is these dots. They are aggregate trades. We get this from Binance. They are not individual trades, but they are a bundle of trades, and they come in real time. We snap it here to 1 second for implementation historical reasons, but they actually come in milliseconds. And I can actually show more. So this is about 1 minute worth of data, and I can show a bit more. I don't know if it is a 1 hour, half an hour. So each one of those dots, they're a series of trades, and second by second, what price, which trades have happened. And this isn't even the totality of the data, because as I was saying, this is aggregate trades. It's not every single trade one dot. It's one dot, it's bundle of trades, but still quite large. And it is exciting to watch, but to actually use it for profit is a different matter. So one big problem is really that with high frequency trades, the idea is that one comes in and buys low and sell high as usual, as quickly as possible. And what I'm not showing here is for which we don't have a representation is the book, the trading book, the order book, which is a list of limit orders that have been placed either to buy or sell at a certain price. And they're usually used as a guide to decide when at what price one can actually buy or sell. certain and what amount of assets. So another book would say, for example, price 59,590. There's I don't know, about $1 million or $2 million worth of Bitcoin that is waiting to be sold. Of course, the problem with that's in a sense, it gives a future perspective, and but it can vary quite rapidly. So the order book as well, it needs to be sampled in real time, and it can be laggy, and just 1 second or a fraction of a second of a lag means that you're behind somebody else. And so I will talk about it in a bit more about those details actually. So basically, the small movements, they're a problem because there's a certain amount of commission that needs to be paid to the broker, to the exchange. So anytime I buy and I sell, there's a commission, for example, of 0.075%. Seems really small, but actually it means that basically for a round trip, one needs to at least make more than let's say 0.2% before open to make a profit. So that's why high frequency trading usually is done with a special account that Binance calls them VIP accounts that have a very low commission rate, or in some other type of assets and some other exchanges, there could be a flat rate. Of course, one needs to have a certain amount. It needs to be like a kind of a special client of that exchange in order to get those kind of deals. And it needs to be said that nowadays there is exchanges that brokers that they claim to have 0% commission, but that in fact means that you automatically get data that is lagging behind, and the faster data is actually given to other bigger players that are in high frequency trading. So zero commission with high frequency trading, it should be also with a feed of data that is actually in real time, that is not delayed to give advantage to other players. And of course, that implies that one needs to be fairly big and well positioned in the market. So zero commission, but even if there is zero commission, there is still the issue of liquidity. So if I buy really quick and I sell really quick, it means that I can only buy and sell a small amount. And that means that, let's say that I can make, somehow I can find a way to gain at 0.01% every minute or every 10 seconds. But on which amount is that performed? It's fairly easy to find an edge and to earn by buying and selling a very small amount. But when the amount is larger, let's say if I have $1 million that I need to trade, I can't possibly do it at perhaps in 1 second. That really depends on the liquidity of the market. So maybe I can make that small percentage, but that small percentage is also on a small amount. So scaling becomes a problem. And that's also actually, so commission is a fight. It's not a fight, but it's an issue with the exchange, with the broker. But then there's a fight over liquidity, which is basically the fight of high frequency trading. The market needs to be liquid enough, and other players also, they have to somehow, that whatever liquidity is there, you fight for it. So another major problem is that it's really easy to have an effect on the market, precisely because it's very easy to manipulate the liquidity. If I'm acting in a fraction of a second, let's say if I'm buying at the beginning of the day and selling at the end of the day, and it is $1 million, it's fairly easy to, even in 1 hour, it's fairly easy to buy and sell $1 million without shifting the market too much. But if I need to buy and sell every second, I will either I need to put a limit order, which means that I have a certain quantity and I will perhaps settle for a much smaller quantity, or I will place a market order, which means that I want to buy or sell that quantity, but then I can't decide anymore the price. So I will automatically, the exchange will give me a, a price that if I'm buying higher and higher as I try to buy that amount, and the price will automatically go up. Perhaps not by much, but in proportion to the liquidity of the market. So in a sense, there is no easy win. If you have a small amount, it's easier to buy and sell, but you don't earn much. If you have a large amount, it's a lot harder to buy and sell at the price that you want. So you have to settle for less profit on a larger amount. And yeah, you're moving the market as well, which means that you can have a butterfly effect. If you have a larger and larger amount, perhaps you can create a cascade effect into the market. Or even if you don't, perhaps you don't in a longer term, but perhaps within 1 minute you create a cascade effect that generally goes against you, unless you found a way to manipulate the market. But even then, it's not something that it can be tested because it's a very fluid situation. So yeah, it can't really rely on passive testing. When doing low frequency trading, one can take several years of data and pretty much assume that he can place those trades without making big changes, without the market being modified by those changes, by those trades that are applied. So, but if it is dynamic, you can simulate perhaps a series of trades, but then the market, the actual market as it was and as it would have been if you were a player in the market would have been perhaps substantially different. And and in general, microscopic movements are just more chaotic, as it can be seen here. It is basically, in many ways, much more random than a movement that can be in 1 day, 1 month, or 1 minute. So they're automatically harder to make sense of, although one could find a pattern even at this level. But then again, to search for a pattern in such a large amount of data, it takes a lot of computing power. And then, as I mentioned, also the big problem is like those microscopic movements. So yeah, because it's so chaotic, the edge that one could find is likely to quickly disappear, because those patterns are not necessarily repeatable across the years or the months. It could be just something that lives for a few days or a few weeks. So in a sense, it's a continuous, there's a continuous need to adapt to the market as it could change. Of course, this is true at every level, but the higher the frequency, the more likely is that behavior to be on the random side of the spectrum, and it's more likely to disappear. And also there is, of course, everybody generally knows that the big player in high frequency, they have especially good location for connectivity, so to have that kind of hedge on the millisecond or microsecond, and powerful, or at least sometimes not necessarily powerful hardware, but hardware that is optimized for reducing lag. So in a sense, in some cases, a microprocessor that is not multi-thread could be better than one that has hyper-threading and all those kind of modern advantages, because the one that is a single thread is perhaps has less latency, can do certain operation with less latency. So it's a general perspective on why I personally don't care so much for high frequency trading. It would be really exciting to try, but it's just not something that you can easily do at home, so to speak. It would be a research to make, but it's less certain as far as I'm concerned, and especially less scalable, as I mentioned, with the issue over liquidity. So other approaches to algorithms, one classical one is mean reversion. The idea is that to buy when, so to speak, the market is, so to speak, oversold, and sell when it's overbought. So the idea is, I actually don't have a display here of, but generally one uses a median average. So a median average would go, let's see if I can draw it. So a median could be something like this, right? And then the idea would be, yeah, if it is below the average, it's probably a good idea to buy. And if it is above the median, it's probably a good time to sell, because it will generally, the market tends to snap back to the median. This could be done at different levels. This is a relatively small level, but one could do it on months or something like that. So this could be an average, let's say, and I'll buy here and sell here, buy here and sell here. It actually doesn't work as well with pairs, with even with Forex, I think, but definitely also with crypto, because mean reversion was mostly, I guess, created for the stock market. At least it was popular with the stock market, and with the stock market, there is a sense of some underlying value of the company. Although some other companies, of course, they can be highly overvalued. But in general, usually a company or even an asset such as oil or whatever else has a base value that is fairly constant or is tied to specific assets of a certain company. So generally one knows when the value is a bit perhaps higher than it should be or is lower. But when it comes to crypto or currency in general, the price can be, I guess, manipulated at a whim, or could be more perhaps not necessarily manipulated, but driven by whatever players, whether they're big or small. So it's unwise to think that for example, Bitcoin is overvalued because it could go on for a long time. So, and in general, the idea is like, if I think perhaps at 40,000 it's oversold, one could say, yeah, I probably bet down, and then of course it continues to go up, because it's not as easy. Although perhaps it used to be on the stock market, but I don't think today even the stock market it works. Of course, mean reversion in general can be still applied, but it's just should be on certain markets, or perhaps not in an individual market, but on an ensemble markets. So it's always a bit more complicated. But in general, I don't think it didn't work well for us. Yeah, one nice thing about mean reversion, or in general the concept of buying when the price is below the mean, is that it's much more easy to pick the bottoms, and that's just it's just satisfying to be able to, for example, to buy here and sell here. But again, the problem is like when one buys and sell, he thinks he's selling high, but it's actually perhaps going to continue going up, and it often is. So so scalping, this is I guess, I don't know, more popular with human traders. The scalping is basically just doing a little bit, just doing really small trades. It's especially, it makes sense especially when the market is moving sideways like Bitcoin is doing these days. So we pretty much know that it's these days is stuck around 59,000. So scalper could say, you know what, every time it's below 59,000. So where is the 59? Here it is. So it's my line. I could say I'll just buy here and sell as soon as it goes higher, and then I'll say go a bit down. And it is, in a sense, it looks great, but you only make a series of small trades. It's not really where the real money is, but it's fast-paced, and it can be exciting. And I guess a human trader can just go on a market in a day and do a bunch of trades, buy, sell, buy, sell, buy, sell, and it feels good, I guess. But yeah, honestly, I don't think it's very profitable. I think it's mostly driven by the fact that traders, human traders, they lack time and patience. And it's just exciting, you know, chasing the next high. You always want to be in a small trade and make that quick buck. But yeah, I think it's suboptimal. At the end of the day, what really matters is like the total profit that has been achieved, and you don't achieve it with a series of small trades. One could say, yeah, but perhaps I can do scalping when the market is moving sideways, and then I can do mean reversion or something else when it's not. But as usual, the problem is like by the time you realize that you're moving sideways, it's probably too late. And even if you think it's moving sideways, you actually need to really pick the bottoms. So it's easy to say, yeah, I'll buy low and sell above, but will you settle for something like this? It's really tiny. And so you say, okay, then perhaps I will buy when it's 2 or 3, 4% below the level. And it can happen a couple of times, but then many times it won't happen, or maybe you'll miss it by a little bit. So I mean, with everything, it's easy. It's easier in theory, but in practice, honestly, it just doesn't work. Maybe it'll work for some people, but I don't think they're making big bucks. So, long story short, what we do is trend trading. Trend trading just means, yeah, like it's longer term. So it really, the algorithms that we use really wait for establishing upward movement and then buying into it. But of course, it's not that easy. And I will go more in detail in a minute. So it's painful to watch trend trading. Maybe if I can display a few of our trades. It's painful to watch. Let's see, a few bad trades perhaps. Let's see here. We sold here and then we bought again here. The problem is like many times with trend trading, the trend is really waiting for to establish a movement, but perhaps it's a bit too late, and then it ends up buying at the top, and perhaps selling lower, especially when the market is moving very sideways like it's been doing these days. So here is a nice situation where yeah, through 2 hours it went up, but by the time the trend following system decided that perhaps there was an upward movement, it was basically too late, and then the price went back down. And so it appears to be sluggish, and then it will try and fail many times, the trend trading approach, like it is shown here. It is basically constantly trying to really find very positive upward movement. The thing is that this is actually more profitable. It's painful to watch. You'll spend many days watching all these failed attempts, but then you end up sometimes getting the real big plus 8%, plus 7%. I think earlier this year we had a plus 20%. So once you're in a positive trend and you buy and you stick with it, you can make the big profits, let's say. And then the rest of the time is basically a waste. There will be times where there's many failed attempts. It is painful to watch. But what matters is the final profit. So compared to high frequency trading, it's definitely less chaotic. So there's a much better chance to find a solution that will last for several months or years even. Because it's easier to find certain patterns. Unlike high frequency, it kind of pops to the eye, or even if it doesn't, it is still less random, so to speak. And it will generate less trades. So this means that is easier to scale. So on average, we generate about a couple of positions per day. So 4 trades per day, 3-4 trades per day. So if I have 1 hour to, or even just a few minutes to open a position, means that I can kind of slowly find the liquidity. So even if I have perhaps $10 million or something like that, I can open that position without fear of the market moving against me. And so because it's less trades, there is less stress about how much is the commission. And I think the trend tends to maximize profit. At least that's what we notice for us. But I think in general it's a better approach. And perhaps at this point I can show a little bit about the indicators at play that we have. I kind of hiding some of the information because I don't want to reveal the secret sauce, but below here, this guy here, it's our trend indicator. So when it's green and it's above 0, it will signal the chance of a positive trend, and when it's red, it will signal a chance of a negative trend. So ideally, in general, the idea is to buy when it's in the green and sell when it's going back to the red. Of course, there's always the issue of managing the risk. So there will be cases, let's see where stop loss kicks in. Where do I have a stop loss? Perhaps here, yeah. So here is still in the green, but of course the stop loss at 2.5 decided that I was too much risk, so it just sold before we could even consider the trend to be a negative. And there are other criteria, like for example buy a line to a certain amount of hours, or using other criteria which go against the trend indicator. So in this case, the trend indicator, what's going on here? In this case, the trend indicator would have made the algorithm buy here, but there were other criteria that prevented it from happening. In this case, it was a failure because it would have been nicer to buy lower, but in many other cases, of course, whatever criteria is in place, it's better. So usually what the truth is in the test. If you test for certain criteria, you want to test it for several years, and if it works in most cases for several years of testing, then that's where you want to go for. So another thing that we do generate levels, significant levels, automatically, and use it sometimes to sell, even though even though the trend indicator would have said that yeah, for example, here we buy at this price, and then it would have been about full red about here, but it actually sold a little bit before because this criteria determined that the price was likely to bounce at this significant level. So, and in this case, it worked out well. In some other cases, it doesn't work out so well. For example, here it sells at this level, this magenta line, but then eventually buys up again because it was at early. Yeah, the position was close to early. And he backtracks on it. So yeah, last slide is machine learning. We do use it, but there's actually, I mean, machine learning, it's a generic term, and it has different uses, and it's basically a set of tools, or maybe perhaps just a concept. To me, it's an automated way to find solutions. Just it allows you to test many parameters or approaches, formulas, and until you find the ideal one, hopefully. Of course, the trick is that it's fairly easy to find the best possible solution on your data set, but that doesn't mean that it will translate into the best possible solution for the future. So that's the big question, and I guess in time series prediction and machine learning as well, at least the type of machine learning that is trying to predict things instead of simply categorizing things. And with machine learning, it's interesting because there is some recursive approach to it. So let's say they have a set of parameters that tell me, that define how the trend for my trend indicator is, what are the best parameters for it. But then there are parameters that define also how I define what is the best parameters, and those are usually called hyperparameters. So let's say that I will use 3 days worth of data, of price data, to determine what is the trend. But then how do I actually determine in the longer term if that's the optimal solution? So there will be also some superset of parameters that tell me, okay, you should evaluate this. You should evaluate the selection of this parameter utilizing the last 30 days or the last 60 days worth of data. And you could set 30 days, and that could be your magic number for being able to give a proper evaluation of those parameters. or it could be a different number of days. So, and that specific number, it's a hyperparameter, and then it could be actually by itself. It could be something that works well only within a certain range of time, or it could be something that works well all the time for all the data. But in general, you need to decide which parameters and which parameters that guide the parameters. Eventually, you have to give some fixed value at some point to something, and you have to settle for it. Otherwise, you can have parameters and hyperparameters, and they could be hierarchical, and you could be a complete range of values. But at that point, you have so many possible solutions that it becomes kind of a wild goose search. So there is what I mean to say is that it's really, in a sense, there is an art, or there is sometimes an individual decision to say, okay, this is the hyperparameter I want to set for. I decide that perhaps 90 days history for evaluating these parameters is my decided number, because it makes sense, because in general I think it does, and then I have to make everything work out based on that. Or perhaps you can keep it dynamic, and then you put into the machine learning whatever level of hyperparameter. I guess, yeah, a very complex, very messy explanation, but hopefully something came out of it. So yeah, machine learning also can be used. We have many different approaches where, I mean, once you get the hang of it, you get the concept. But the two main separation is offline use and online use, as far as I'm concerned. So offline use is, let's say that I'm trying to determine, whether perhaps a certain indicator, a certain generic idea really makes sense at all. So I will do a few tests. I will play with it, and then the machine learning system will tell me, will allow me to get a sense of whether some idea has a future or not. So this is something that never goes online. It is something that perhaps one doesn't even do in the runtime itself. Perhaps it's some separate research that one does in a different language, in a different system, but it is in a sense kind of a helper for a researcher. And then there's the online use. The online use is like when I was talking about parameters. So for example, this trend indicator could have a certain parameter that says, use take the last 3 days, 4 days, 5 days as a sample data to build a sense of the trend. And that by itself, some of those parameters that are in the algorithms, they are actually dynamic, and they are evaluated, they are adjusted, they are generated as the market evolves actually online. So could be every day. There's an assessment that is made, and those parameters, they can be adjusted. So that's the online, as I call it, online use, because it's kind of a living thing. It's not a one-off research result. But yeah, with machine learning, there is no magic solution anyway, because whatever you do is heavily dependent on parameters, hyperparameters, whatever, and also on the past data. So it's very easy to build something that is extremely efficient with a set of data. If you make something complex enough, and that's fairly easy to do with a system that has a dynamic level of complexity, it could be in a sense kind of like self-modifying code, where you don't simply build an algorithm with a set of indicators that you give, but you actually build a system that will use any number of indicators with any number of parameters, and that will possibly create a perfect solution even for perhaps 10-year worth of market data. The problem is that that's kind of a definition of overfitting. You generated something so complicated and it's so perfect that works so well for that specific set of data, and maybe next day it will a month forward it will be from the best looking algorithm to the worst possible. So the solution to that is to have proper statistical testing. That's a whole separate topic. But yeah, that was I'm sure this is a very long video, but I couldn't make it smaller, I think. And I left a lot of stuff behind out of it. But yeah, I hope this gives a general explanation. If anything, at least I made it look very complicated, so people will think that they should use my system because they couldn't possibly tackle this problem. But yeah, I don't know. It's not that difficult. It just takes a lot of time. So until next time, have fun.